Intrinsically, because our currency's fiat, because they print more money than they have backed by anything, the only way the buying power of a dollar can go is down. It can't go up. It's impossible. There's nothing behind it.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are here with Gary Wagner, executive producer of the goldforecast.com. Gary is a professional in the technicals of precious metals and predicting their prices into the future. I met Gary personally at the VRIC up in Canada, and he's a stand-up guy and a gentleman. Gary, thank you for coming on the show.
Hey, it is my pleasure to be here. As you said, we've met in person, so it's nice to sit down and kind of chat about gold.
Yes, yes. Can you give us a 2-minute summary of what you do and how long you've been in the gold business?
Absolutely. I began to get involved in 1983. I worked for a company similar to Monex in that we sold physical silver and gold to our clients. My grandfather was actually a gold trader in Hungary before the war. My brother-in-law is a refiner, so it's kind of been in our blood. I remember taking trips back in the 60s and 70s when it wasn't so legal to buy gold bullion. And my father would go to New York and buy it by scrap weight or penny weight was the way they kind of got around that. So my roots are I'm a first generation immigrant. My parents came after the war from Hungary, and they really beat into me the importance of a hard asset, a safe haven asset such as gold. My mother used to tell me stories about a loaf of bread. So that was ingrained in me from an early age, but I always thought I would do something different. But I went to a commodity firm in 1984 and I was stuck. I knew this is what I would do for the rest of my life. So I started as a broker. I didn't like making money when my clients lost. So I became a CTA, commodity trading advisor, which means that I'm performance based. And if we make a profit, I take a part of it. And then candlesticks kind of emerged in the early 90s. And they were on all the charting systems, but nobody knew what to make of them. And I was fascinated by them. And I had a client that was probably one of my most successful clients I've ever had. His name was David Moore. He doesn't mind me mentioning him, an engineer for General Electric when they were a big solvent company. And I saw him trade 10 to 12 trades successfully in a row. But more importantly, as like, for example, oil was going up and everybody was buying, call me and say, listen, we got to sell oil, sell it for me tomorrow morning on the open. I go, David, you realize everybody's buying it. They're saying it's going to, X, Y, and Z. He says, oh, that's okay, but can you take my order? I said, of course I can. And after watching him quadruple his account in a time span of about a month and a half, I said, David, what the heck are you doing? And he said, well, I can't explain it to you, but I will do you one better. And he sent me a book by Seiko Shimuzi called The Japanese Chart of Charts. And it explained candlesticks, an extremely cryptic book that took me about 3 reads. But once it clicked, it was kind of like the Matrix opening up. I had a sense for what they were doing. And to give you a 1-sentence explanation of why candlesticks are important, is they're the only form of charting I have ever seen that mathematically quantifies market sentiment. And that's if you can think about, to be able to put numbers to how people feel is, how do you do that? They did that. And they realized that certain types of candlesticks in the patterns they form were indicative of a market that would continue in a trend, consolidate, a pivot point, a key reversal, things like that. Once I incorporated that into my trading recommendations, the world changed for me. And I wrote my first book, Trading Applications of Japanese Candlestick Charting in 1993. And I wrote the first software application to use computers and AI to identify candlestick patterns in 91. And that's when it all got started.
Awesome. That's awesome. I love charts. I love technical analysis. It's a visual representation of what millions of people are doing in the form of a graph, and price action. It's a beautiful thing. Okay. Big picture view. What is your macro view, your big picture view of the world economy and financial markets?
But my macro view is that, listen, we've just gone through a period in history that our grandkids will ask us about, which is the pandemic, the recession, and the recovery. And so we dealt with things that no civilization had to deal with in this modern age. And and I'm 67, I never remember a point in which globally the economy shut down. People stopped going to work. All of the things that came with it, besides the hardship, the sickness, and all of that. The recession that followed was a difficult one. And so realize that prior to that, we had one of the longest periods of economic expansion in history. I believe it was around 17 years of straight GDP growth. So my micro view is we've got a ways to go before things get back to what I'll call the new normal. Macro view is that we will be buzzing on 8 out of 8 cylinders, maximum 4 to 6 years. I think that it's going to take time to work all of this through the system. The Federal Reserve made a blunderous error, in my opinion, by not raising rates in 2021. They were at 2% around January, the beginning of the 21, and they started creeping up. By the time they raised rates in March 2022, inflation was already at 8%. Ran, I believe, 9.1% the following month, and they raised it by a whole 0.25%. Had they raised rates when it broke their 2% target, which I believe was March of 2021, incremental interest rate hikes of maybe taking it from near zero, which is where it was, to maybe 2 or 3%, might have fixed it. But the fact of the matter is, because they thought that inflation was transitory, that assumption was a death penalty for the Federal Reserve, because at that point, once they started raising rates and inflation's already at 8%, all they can do is react to it. It's a reactionary Fed and not a proactive Fed, and the Fed needs to be proactive, and that was the big mistake. And so that's why it will take years to kind of climb through it, because what we're looking at the possibility of next week, the Fed meeting and enacting their first interest rate hike pause in the last 11 FOMC meetings. And that kind of an aggressive monetary policy, I believe, was absolutely needed, because inflation was entrenched. It was out of control. They had to do something. And that and the money supply are the only two things that they really have to affect an economy. But the bottom line is this: the idea of bringing inflation down is done by contracting the economy. So the GDP slows down, our national debt grows, and it builds a whole bunch of other problems on the tail end of that. My sense is that if they would focus on making our economy robust, increasing our GDP by not raising them as much as they did, the debt problem and crisis we have, I'm talking about our national debt, not the debt ceiling, but the fact that it's that high. The only way we're going to get out of it, in my opinion, is by having such a robust GDP that we have tons of money to pay that debt off.
Yeah.
I can tell you from personal experience, as I was in my teens and a young adult, and I didn't know how to handle credit quite effectively, the way I got out of debt and became solvent again is I made a lot of money.
Yeah.
It's hard living week to week and to catch up to anything. And so the macro view is that things will be back to normal in a short period of time. The micro view is that it's not over yet.
Good. Okay. All right. Listener questions. Blaine asks, what is Gary's prediction of a possible, he calls it Executive Order 6102 version 2.0? So what he's talking about is when Roosevelt essentially said, you can't own gold other than, 5 coins for, what do you call it? Collecting. Do you see any risk of this, of governments kind of doing another order like that?
I think that the probability of that occurring is closer to 0 than any other number. Realize in 1930 to 33, we were at the roots of the greatest of all recessions, a depression. And so Roosevelt knew that he had to do something dramatic. So he enacted a law in which all citizens had to relinquish not only all of their gold coins and silver coins, but their gold certificates and silver certificates, the dollar and the banknotes, because they weren't fiat then. You could take that banknote, go into your bank and say, here's my $20 bill. I'd like to have an ounce of gold. And boom, they would transfer it. So we were still on a gold standard. And so what he did is by confiscating all of the gold, which I believe was an interesting thing to do, but the outcome was that America became the greatest nation in the world in terms of financial strength and the ability to rebuild the infrastructure, our roads, to put people to work. He literally took us from a depression to a booming economy by doing that. One of the interesting things is, of course, if you look at the price of gold over time, it sat at $20 per ounce through the 1800s into the early 19th century. And then about a year and a half after he confiscated the gold, he raised the price of gold from 20 to 35 an ounce. Now, of course, you can do that when you own all the gold, but he literally fairly much doubled the coffers of the Treasury. Now, realize this was a different time. This was pre money machine printing. This was pre Keynesian economics, where the idea was you print as much as you need to revitalize the economy, and that's okay. We're living in an experiment, Steve, if you think about it. If you go back 100 years, 500 years, 1,000 years, whether it's any civilization that's a kingdom, a fiefdom, or any of that, you could spend the amount of money equal to what you had in the Treasury. When you ran out of money and you wanted to build more towers or more this or more that, you had to do one of two things: either A, raise taxes, or B, go and pillage and plunder the city or the state next to you, which is what happened. And so when we went and started to erode the gold standard, which was a series of steps. The first was Bretton Woods after World War II. After that, it really was finalized. The nail in the coffin, I say, is by our most honest president we ever had, Richard Nixon, who basically abolished the gold standard. And that's when gold actually started to run. So do I think that there's a possibility of that happening? Not without some real rioting going on. I can't foresee that.
Okay, I'm in the same camp. Okay, can you share your screen and we'll take a look at the gold chart?
Absolutely. Just give me a second here. What I want to pull up is a long-term chart. It should be up on the screen now.
Okay. All right, we see it.
What you're seeing is a daily chart that goes back really to 2020, 21. This is the first of our record highs. This is $2,085. And it occurred right before March when inflation was spiraling. Realize it was at about 8%, 9%, and they raised rates by 0.25%. It was a small interest rate hike. It's like I'm thinking of a small leap for man, a great leap for mankind. But what happened is, you can see in the red boxes and these green boxes signify lower highs and lower lows. So we had a multi-month correction going from 2,085 down until about the end of September, the first time that gold challenged $1,620. If you look at that, that is a tremendous move, $400 move to the downside. It hit that bottom in October, and then on November the 3rd, and I remember this date because that was the date I thought, if it tests and hold this area, it can't do anything but go up. We started to see a significant rise in the price of gold. But the interesting thing is why it rose at that point, because the Fed was still raising rates, correct?
Yeah.
And so what would cause gold to go from, say, 1,600 to the first level of 1974 by February 2023 during a period of quantitative easing and Fed tightening? And the answer to that was that market participants were under the illusion, and I really mean this, under the false perception that the Federal Reserve would cut rates at some point this year.
Yeah.
And the reason that that hit me so strongly is because the December FOMC meeting in 2022 had a dot plot that was dramatically different. And the dot plot is the forward guidance of the Federal Reserve for the next 2 or 3 years that said that they emphatically would continue to raise rates. Their target was anywhere between 5 and 6%, and that they would keep those rates elevated throughout the entire year. But the public didn't believe that. They said, no, they can't pull that off. They're going to cut rates, and they never did. And so the market went up to the point where it tested that all-time record high again, which is the recent thing that we saw, about the first week of May. And from there, it's been coming down after hitting a low of about 1930 on a chart. So what that shows you is that we've hit this double, some say a triple top, because we've got a series of these highs that come in. It's different than the triple bottom in that the triple bottom, if you look at it, I've got a blue box around it. It occurred in a short period of time, end of September, beginning of November. Whereas when you look at the triple top and they're looking at this top here, this top here, and then this top here, they occur over a time span of multiple years. So it's not, to me, it's not the same type of a triple top or a triple bottom because it's spread across. I believe inevitably it will be taken out. I am looking for the end of this year, first to second quarter of next year. And the reason I don't believe that this triple top will hold in terms of absolute resistance is the same theory as when we look at land or real estate or any hard asset over time. Because we have a currency that's based on the good faith of our government, and I'll go ahead and remove this chart so we can talk a little bit, but because currencies are fiat now, the buying power, and I'm not talking about the strength, they talk about, oh, the dollar is strong. Well, they talk about the fact that it's strong relative to a basket of currencies they weigh it against. And with all these countries printing money like it's going out of style, it's been a race to zero. The buying power of the dollar is atrocious compared to what it was 5 years, 10, 20, 30, 40 years ago. I mean, my age will show, but I remember a candy bar was a nickel. I remember things being so where a dollar actually bought something and $100 bill was, my God, it was a substantial banknote. I remember going to New York when I was 18 with my family. My dad handed me 2 $100 bills. He said, I never want you to be broke in New York. And you know what? I didn't feel broke just because I had these 2 $100 bills. My God, I couldn't do anything with that in New York now.
No, that might buy you dinner.
Yeah. Well, if you're eating alone, it probably would. And that's the ultimate reason I'm attracted to gold. There's an example I use in a lot of my long-term classes or studies about how gold has pretty much kept up with inflation in terms of the buying power of an ounce of gold relative to the buying power of a US dollar, which now has diminished considerably. Back in the like say 1913, I think that's around when the plaza opened up, you could go to New York and with either a $20 bill, banknote, or a $20 gold coin, you could buy a nice suit, stay at the plaza for the weekend, get a steak dinner and a shave and a haircut, right? And so if you look at that, either of those two methods would have paid and settled that payment. Now, let's move ourselves forward. Now you have a $20 bill and a 1 ounce round of gold. The $20 bill might buy you a couple of cups of coffee and a donut, but that ounce of gold is worth what? About just shy of $2,000. Well, you can get a decent suit for $1,200. I'm not saying $5,000, but you can get a suit. Plaza, a regular room, maybe $600 to $800. Steak dinner, maybe $200. Shaving a haircut, another $100. You can still buy the same items today with a gold coin as you could 100 plus years ago. And that's what I mean by keeping up with inflation. It doesn't move tick for tick with inflation, but intrinsically, because our currency's fiat, because they print more money than they have backed by anything, the only way the buying power of a dollar can go is down. It can't go up. It's impossible. There's nothing behind it. And so to me, that was that, besides my upbringing and my parents telling me you want hard assets, don't be consumed by notes that don't really have any value, because I've seen them become worthless. They are in, when I'm a single dad, I take my two kids out, even fast food, it's sad. It's $50. If I want to take them to a decent restaurant, it's actually, it scares me. And I'm in a position where I don't have to watch my dollars. I'm not living on a constricted budget. And I feel for those that are. Yeah. Because anyone that is making a salary that remains pretty much constant with the buying power of the dollar going down, each month gets a little bit more difficult. The last report on the PCE showed that consumer spending is robust. It rose by 0.08%, and income rose by 0.04%, so half. So they're spending more, they're making a little bit more, but not enough to keep up with it. And you know what's happening? We have an enormous amount of credit card debt amongst American citizens, and that's painful, because at loan shark rates, which is what they are, 20%.
Yeah.
That's going to make it difficult for them to kind of tread water again. And so that's the task that I feel most at home with, trying to save. And that's why what I try to do with my livelihood is express the need for all Americans, for all citizens of the world, to have part of their portfolio into hard assets. Not all of it, but part of it. And not to keep a whole lot in cash, because cash today is not worth the same value that it's going to be a year from now. Now, for the first time, they actually can yield some kind of an interest-bearing return on that. But think about it, prior to these rate hikes, you had a $100,000 CD that earned 0.5%. My God, that's nothing. And so those are the hard times that I'm talking about. We need to get through. I'm very optimistic about the future, but I'm cautious about what it will take to get there.
Yeah. Yeah. Okay. We answered GVK's question about the triple top. You're putting less emphasis on that simply because it's spread over the last 3 years, right? Whereas that triple bottom that we had on 1620, it was pretty much within a month and a half or 2 months. That was
right. But more importantly than the time span, which is important, is the fact that, have you ever seen over a period of 20 or 30 years the price of any real estate anywhere in the world go down?
Well,
in other words, a hard asset that has an intrinsic value will remain to have an intrinsic value. And if the currency that you're bartering with is having smaller and smaller buying power, eventually that top has to be taken out. I mean, I'm in Hawaii, where I see these homes appreciated in a period of 2.5 years, like 30-35%. Now, it'll go through a cycle, and we've seen a housing boom and a housing crash, and that will always occur. But over time, the price of a home compared to 20 years ago is greater, compared to 20 years ago to 40 years ago, and so forth. And that's the primary reason I don't think that their triple top will hold, because it's a hard asset. And when paired against a fiat asset, an asset that doesn't have intrinsic value, it can only go up. It's just not if it will go up, it's how long it will take to go up.
Yeah. Now, what's your price targets in the short term? We're looking at imagining the chart right now around like 1915, 1920. We've got the 150 moving average, and then below that around the 200 average. I think it's around 1870 or so. Do Do you feel like maybe that 150 or hold, or you looking more towards the 200 to kind of get a bounce off of that? What are you
I
thinking?
mean, the 200's down to 1843, so that's kind of
Oh,
out
it
of the
is.
picture.
Okay.
Yeah, as long as yes, it's a daily chart. That's your extremely long. I mean, that's what equity traders use to determine bullish or bearish on a very, very long term scale. The 100 interim, the 50-day moving average is short term. The fact of the matter is first of all three of those averages are in what I call full bullish alignment, meaning the lowest value is 200, then 100, and then 50. We are back above the 100-day moving average. We broke below that about a week and a half ago. The 50-day is sitting at 2000, so that's major resistance. Support to me comes in at approximately, I'd say 1940 to 1960.
Okay. All right. That's good. I'm really hoping we don't drop below 1900, but if we do, we're probably going to hit the
1950 is exceedingly important support on a technical basis. Now, caveat to that, this is a news and event driven price market. These markets aren't moving because it's above or below a technical average. They're doing it on what the Fed says, what's going on with the Treasury, our debt, our level of debt, our economy, and things of that nature. So could it go below 1900? Yes. Do I think it's likely? No. Do I think it's remotely likely? I wouldn't even go remotely. I think that it's got a solid base right now. The only thing that could drive it to those extremes is if the Fed pulls a quantitative easing act like we saw in a period of time when they took interest rates to what, like 15 and 16% to combat exorbitant inflation. When they go that high, first of all, who can buy a house? You can't.
Yeah.
And when it's that high, if you can get a 15% return guaranteed on a government bond, it takes a non-yielding asset such as bullion to take a back seat to that. And that's not the case. That would drive it lower. But I personally don't think the Fed would ever go beyond 6.5%, 7% personally. But again, I don't have answers to these. I do have opinions, but it doesn't make sense. They're going to keep it elevated at these levels. What I think the Fed's going to do is a hop. That's the expression I've heard termed, which is they're going to take a rate hike pause. So the 11th consecutive FOMC meeting is the first time they don't raise rates. They, depending on how the data comes in over the month till the next FOMC meeting, they'll either continue the pause or raise rates. You won't see it lowered. I don't think that you're going to see the level of interest go down in 2023, period, end of story. And so I think that there's going to be good support above 1900. Absolutely.
Okay. Good news. All right. Can you share your silver chart screen? Okay, there we go. Christopher asks, what is your general market sentiment on silver? Do you see it breaking to new highs by the end of 2023 or early 2024, similar to gold?
Well, silver's been a different animal. It hit $50 on a couple of occasions, but on the last subsequent new price highs in gold, it wasn't able to keep up. And so it would peter out at around $30. We hit $27 back in March of this year, and we hit $28 back in March of last year. So on these last moves up, not only did it not recapture the all-time high at 50, but it came in under $30. There's an industrial component to silver that makes it unique. I think that if gold runs to all-time highs, as I believe it will by, say, first quarter next year, I think we would see silver go back to 30, maybe even $31. Will we see the days of $50 an ounce silver? I hope so, because I've got a lot of physical, but I don't believe so, because the technical studies, just historically speaking, it hasn't been able to breach that $30 mark. Will it go higher than it is right now? Well, it's currently trading what, just below $24. It will easily test 26.50, which is the high, the rounded top that we got between April and May. Will it go to 50 again? Possibly one day, but we're talking about a decade away. I don't see it, but I am bullish on silver.
Okay. Okay. Gold's going to move first and then silver will follow.
Well, even if they move in tandem, what we tend to get with silver is during periods of price ascent or rallies, silver outperforms gold in terms of percentage gains. When it's in a corrective stage, silver tends to outperform gold in terms of price decline percentages. But overall, it hasn't been able to as easily climb and make new highs. And the key is that gold is the ultimate, not inflation hedge, but it's the ultimate safe haven asset, where silver is a little bit different because of the industrial component. Now, incorrectly, I believed years ago that it would move higher once again because of the whole green revolution, solar power, all of the technology that is really immersed in the use of silver, but that didn't come to fruition. And here's the key. Because I don't know what these mines produce and what's in the ground and the things that geologists know, I would have to say that it's probably related to how much is available, how much is still in the ground. Because when you consider gold, all of the gold reserves that we know of, mined, unmined, and recycled, if you think about the Statue of Liberty and the base that it's on, which is the size of a house, if you took all of the gold in the world, it would fill that block that the Statue of Liberty is on. That's not that much when you think of that's the world supply of gold. Silver is much, much, much greater.
Okay. Okay. All right. Crypto Dust. You can probably tell by his name what his question is.
Okay.
How would you compare Bitcoin to gold as far as a store of value?
Apples and oranges. We were speaking pre-show, and the beauty about cryptocurrencies is the blockchain technology. It's amazing. It will transform the way companies do business. It decentralizes controls, gets out of the hands of the bankers, and will do a huge amount of good in the world for things besides the speculative part of cryptocurrencies. Is there a place for cryptocurrencies? Absolutely. There will become a time in which there won't be physical banknotes. I mean, to me, that time has already come. I rarely have dollars in my pocket, except when I'm going to play poker. We talked about that a little bit, but everything is digital. So if it does come down to where we're working only in the digital realm, Ethereum and Bitcoin will have a stable place. They've already identified themselves as Kleenex or Xerox or that brand name, so to speak. However, intrinsically, there's a real value to gold. You can do things with it. We use it in all kinds of technological applications. If you go up in space and your shield's not covered in gold plate, you go blind. I mean, look at satellites, they're all covered in gold. Gold has properties that can be utilized, and those utilizations make it have an intrinsic value. You can't eat cryptocurrencies. My son is an advocate, but then he's 33, and so he's at that age where it's the new sliced bread. And so to me, the first thing I told him was a story about tulips in Holland, is that it's supply and demand, and it got so overheated. But to me, it's still the wild, wild west. There's exceedingly important applications, but it doesn't have intrinsic value. Would I trade, even though if I had, let's say, 10 Bitcoins and 3 acres worth of land, it's likely that the 3 Bitcoins would way overproduce in terms of a return, but it could become worth much less. And the distinction, and this is where it gets tricky for me, I can explain, at least in my head, why gold goes up or down, why the dollar has more or less buying power, why a commodity goes up or down, but a cryptocurrency goes up or down based upon how many people want it and think it has value, and how many people want to sell it and don't think they think it's overpriced. Yeah. And so Is there a place for digital currency? More than a place. It will stand the test of time. At some point, banknotes will not be really used at all, and it will go digital. I believe that there's more of a chance that it will be a country that captures the digital currency market, only because they don't want the anonymity that these cryptos give you. They have a hard time enforcing paying taxes on them. And so because of that, they're going to be reluctant to want it to be mainstream. What I told my son is when I can go shopping and pay my taxes with a Bitcoin, that's when I'll have some more faith in it.
Yeah, yeah. A part of me, I keep going back to the argument of gold has been around for 5,000 years, and we as humans have decided that it's been money for eons, and Bitcoin's been around for like 13 years. You know, Bitcoin's been to war against thousands of currencies, and gold has been to war against thousands of currencies and won every single time. And Bitcoin hasn't been to war yet. You know, it's unproven in battle. It just doesn't have the track record. A part of me is I have some just in case I'm wrong, but I'm afraid that it could be error.
The one story I can relate to our viewers is that I have a good friend of mine, and one of the smartest guys in the room when you walk into a place. And back when Bitcoin was worth maybe a dime to 15 cents, he began to mine it. And he mined so many Bitcoins that he told me he used to go to Las Vegas and they had slot machines where each pull was 1,000 Bitcoins. They were worth 10 cents. And so he's independently wealthy. He's half of my age. And in fact, when we first met about 5 years ago, he goes, well, I'll tell you what, you take an ounce of gold and I'll take a Bitcoin. Let's see who makes more money next year. And of course, he 10x'd me. And I said, well, you got me there. It's a crazy market. And all I can say is his problem is he doesn't know how he can work with it, because, you're sitting with 1,000 or 2,000 Bitcoins right now. You've got to slowly pull it out and then pay your taxes on it or do something with it. It's not as liquid as you would want, but that's kind of problem I wouldn't mind, but I wasn't smart enough to mine it when they were 10 and 20 cents. So the people that got in it early have become billionaires and millionaires from it, and I take my hat off to them. Will it remain to have intrinsic value? Probably. It will have some value because of demand, but I'm not good at forecasting prices with it because I don't know what to look for. What I do know is that there was something written in the code in which it's called a half-life, where at a certain period of time, it takes twice as much work putting the blockchains together, which is how the miners get. Mining is simply doing accounting. And they're the ones who are doing all of the accounting and passing it through the blockchain. And they get a reward for doing that. And that goes in half every so often. And so by doing that, he made Bitcoin a finite quantity. And that was brilliant, because some of these cryptocurrencies are vaporware. They're made out of thin air and they just keep printing them. Yeah. And so there's some smart logic in Bitcoin in terms of how the code was developed originally.
Okay. All right. Have you, do you follow oil and copper at all? We have a listener question on
Yeah, to a degree. There's been times that I've speculated in both of those markets. Times I've done very well, and times I've gotten my shirt handed to me, to be honest with you. As far as copper goes, so does the economy. When GDPs globally are robust and things are in gear, and these economies are running on 12 out of 12 cylinders, or like an exotic foreign car, the utilization of copper has to go up because it's so highly used in everything. The wiring, the building, all of these substructures within the infrastructure of cities growing. Oil is a different animal. It is supply and demand. There's only a limited amount, although now we're fracking here, which scares me. But the bottom line is it's at the whim of a cartel with oil. So when I first got into futures, I used to clear through a company called Saul Stone, which is now StoneX, one of the largest FCMs, futures clearing merchants in the world. And I remember talking to like the number two guy, and he said, you know, we specialize in lumber and pork bellies. And I go, well, why is that? He says, well, we own all the cold storage units in Chicago. So if we're long and we want pork bellies to go up, we just don't release them out of storage. And we do the same with our lumber. So they controlled that market. And because they had a tremendous amount of the inventory that made up what these future contracts were composed of, was it a fixed market? Well, to, you know, read it any way you want to. Is it illegal? No. I mean, it's smart, but the thing about it is he who has all of the coins is able to control the price of the coins. So with oil, I have to bring that into perspective. As long as it's price is based by a cartel and the cartel can turn the spigot on or off, where it's going to go is going to be determined by that. And since I don't know when they're going to turn the spigots on or off, it's a much harder market to predict. You know, we know usage will go up for heating oil in the wintertime, you know, in North America, but we don't know a lot about the reserves and who controls. We know who controls them, but what they do to determine whether or not they're going to release a lot or they're going to hold back inventory. So because of that, I tend to stay away from markets that can be manipulated, because a small group of people control a large amount of the physical inventory.
Yeah. Okay. Our last question from Akelia. Where are the metals heading in the near future in 6 months?
We are certainly still within a full-blown rally, but the rally consists of periods of growth and periods of price decline. Right now, we just came out of hitting what, $3 to $5 shy of the all-time record high, 83. It came down and went back down, I believe, to 60. I think that I have to look at support and resistance again. I think that it's going to challenge $2,000 per ounce and move above when a certain thing happens. And what that thing is, and what as a investor I would look at, is right now people are intently focused upon interest rates and the interest rates being elevated, being raised. That works against gold. So you have a push-pull scenario. But inflation has been coming down, but I believe the components of inflation will remain sticky, persistent, and they won't go down that easily. And when market participants focus on that inflation remains persistent and not that interest rates are elevated, you'll see it move up. So short term, if they have a pause and stop raising rates, I believe they'll keep them elevated. But if inflation remains stuck at around 4 to 5% core versus headline, you'll see it rise back above $2,000.
Yeah. Okay. All right. Awesome. Well, thank you very much, Gary. We can check out all things Gary at thegoldforecast.com. We'll put a link down in the show notes. Gary, thank you for coming on the show. You have a great rest of the day, sir.
You too. It was a pleasure speaking with you. Have a great day.